Greetings, everyone, and welcome to our August 2023 quarterly macro and market update with our Chief Investment Officer, Michael Dow. I am Julian Fraser, your Director of Risk Management here at Beacon Pointe, and it is my pleasure to be your macro and market moderator for the third time. We've got a lot to cover today, but before we bring Michael in, just a couple of housekeeping items. So if you have questions, and we already received a lot of questions ahead of the call, so thank you very much. So we will get to them throughout the course of the call today. We have budgeted up to 90 minutes for this webinar, and we have more than 50 slides to cover. And we get a lot of great questions from our audience, and we want to make sure that we have time for Michael to address as many as possible. So that's why we have 90 minutes budgeted today. But if you haven't yet asked a question and you'd like to do so, please type it into the Q&A box at the bottom of the Zoom screen, and we will address those throughout the course of the presentation. Also note that we are making a recording of this webinar available next week on the Beacon Point of View's YouTube channel, and it'll be specifically at beaconpoint.com/videos. It'll come out on Monday, I believe. Okay, so what's on the agenda for today's call? In the first section, Michael will talk about the global economy and capital markets and where they stand. In the next session, we will focus on the current events in particular, so specifically the lack of equity market breadth, the US sovereign debt downgrade, the economic data divergence, and what's different this time. We will then revisit our cyclical thesis of late cycle dynamics, and we will wrap up, as usual, with how to position portfolios to take advantage of some of the macro themes that we're seeing. Without further ado, Michael, the floor is yours.
Julian, thanks very much. We have a lot of information to cover, so we're going to jump right in with a quick recap of what we think are the most important things to try to understand when positioning client portfolios. And we'll begin with the what do you need to know about investing questions. They are, what's the economic outlook? We have a couple of slides that we're going to address today that suggest that the uncertainty level and the confidence that economists have in the outlook is really quite low, and that the uncertainty level is high. And as a result, it makes it much more difficult to try to position portfolios when there's a high level of uncertainty about the macro outlook. And we've decided to call those things no landing, soft landing, or recession. And I'll talk a lot about what each of those means, both in terms of the numbers and in terms of the implications for portfolios. Once again, the most important thing remains the inflation and the Fed. Are we done with rate hikes, or are there more to come? And if we do have more rate hikes, it probably means interest rates are going higher. They have bubbled up today again. They've breached what was, in our view, the peak of interest rates that occurred last October at 4.24 on 10-year yields. We hit 4.30 today. We don't know where they're going to settle today, but interest rates have continued to move higher as the probabilities of recession have started to decline, at least in the market's view. And then finally, we talk a little bit about corporate profits, whether they're resilient or not. And these are the things that must be addressed. So the economy, inflation, and corporate profits. I'm going to start with a bit of a preview and suggest that the current data is pointing towards either a no landing scenario, that is we're not actually slowing the economy. The economy is not slowing as anticipated by the Federal Reserve. That's a no landing. It means GDP is going to remain a little bit higher than the Fed would like, because that continues to put upward pressure on inflation. And as long as there's upward pressure on inflation, the Fed's going to continue to act. So a soft landing would be Goldilocks. I've got it in a kind of a gold color here to reflect the fact that the soft landing is the Goldilocks scenario, and it is currently the base case. So the level of the equity market, the level of the bond market, both here and abroad, are currently pricing in a soft landing scenario. What about inflation? Fed's probably done, but that comes with a huge caveat. The inflation numbers did have a substantial decline from a year ago when they peaked in June of 2022. Just last summer, we were at 9% inflation. We're down to 3%, but they ticked up a little bit in the most recent reading, and that is worrisome to the Fed and actually points to a no landing scenario as opposed to a soft landing scenario. So the Fed's likely done, and interest rates are likely near the peak, but it all depends on inflation. And what about corporate profits? They're currently resilient, which is why the equity market trades where it does today. It's a couple percent off of its recent peak, which is down from the all-time high of about 4,800 on the S&P back in January of 2022. But we're pretty close to it. We're within 5 or 6% of the all-time peak. So it's a pretty rosy scenario that we're seeing. But bottom line, we need to know or address, at least, you will never know for sure, but we need to address and have an outlook for what the economy is going to do, how that affects inflation, and what does it mean for corporate profits. Generally, we save this slide for the last, but I thought I'd just start with a conclusion. How do you position a portfolio? Because we could talk about macroeconomics, we talk about the Fed, talk about all sorts of things, but what really matters is positioning in the portfolio so that we can protect clients to the downside and take advantage of the opportunities that present themselves. In the late cycle, we're in the late stages of the business cycle. We call that the late cycle. The dynamics are pretty well understood. You have peaks in things like economic activity. You have peak monetary policy accommodation. All of these things tend to reverse. So you have less monetary policy accommodation, you have less economic activity, lower GDP, and the outcomes, as forecasted by blue chip economists, tend to diverge pretty dramatically. So what you have is a situation where the uncertainty about the outcomes is growing, and that just makes it for a very challenging investment environment. But to put a conclusion first, we're positioned neutral overall risk. We're overall neutral in the stock market, but the tilt is to value versus growth, and from out of the U.S. and into international equities, based in large part, frankly, by the valuations of the big 7 mega cap tech stocks. In terms of interest rates, bond yields, particularly bond real yields, that's yields adjusted for inflation, which, by the way, is your best metric for bond market valuation. Is it rich? Is it cheap? The bond market? Look at real yields. That's the first thing you want to know. And with real yields now well above the 20-year averages and close to 2%, a 2% real yield is an astonishingly attractive real yield. So bonds are attractive, and we've added interest rate risk back to the portfolio. And may do more in coming quarters. But the most important thing to remember always, if you're investing over the long run, what you're trying to do is capture risk premiums that allow you to retire the way you want to retire, or to achieve your foundation and endowment investment objectives. Capturing risk premiums is done in the least efficient markets. It's better to pursue risk premiums and risk and returns in the less efficient markets. So almost always we're going to say it's attractive to be in an alternative investment, private alternative investments in particular, less so liquid, but private alternative investments to capture risk premiums, et cetera. But right now at the late stages of the U.S. business cycle, the uncertainty levels are high, and it's best to kind of stay close to home. So stay close to the strategic allocations, which is close to the benchmark. Don't take outsized risk because the uncertainty level is high, and it's very difficult to get any kind of conviction about the directionality of this marketplace. So, as we always do, we'll start with global growth, and I'll jump right in. This is the global PMIs. It's JP Morgan's economic activity indicators globally, and they split it out between manufacturing and services. Manufacturing is in contraction mode here. So going back to 2 or 3 years, what you have here is a number below 50. It's a diffusion index. So any number below 50 means contraction. Global manufacturing is in contraction. Global services were a bright spot for the first half of the year. But as it stands right now, global services, while still expanding, are rolling over. Looking at the PMIs on a country by country and regional basis, emerging markets remain a bit of a bright spot. Eurozone is slowing and seems to be accelerating, driven by France and Germany. And Brazil, alone amongst the BRICS, seems to be stumbling into a slower economic environment. And they're the only central bank besides Chile that's actually cutting rates based on their economic activity level. They're trying to boost activity in Brazil. So the global situation is it's not good. And the reason it isn't is because global central banks have been in a tightening mode for the last 2 years. And global tightening of central banks, that is raising interest rates. You can see here, emerging market interest rates went from about 2.5% to 7.5%. Developed market central bank rates on average went from 0 to 3.25%. These types of moves have a tendency to have the desired effect. If you're trying to dampen economic activity in an attempt to lower inflation, which is the central bank's raison d'etre, then this is what you do. So this is a very much of a garden variety tightening cycle from global central banks, both developed and emerging. There's just been so many more rate hikes in the last year. If you sum up all the rate hikes across all the 70 or so central banks that we follow, there's been 246 rate hikes and only 10 rate cuts. Brazil and Chile are the only countries to have cut rates in the last 3 months. So global central banks are on an aggressive tightening cycle, aggressive tightening mode, and they're getting what they want, which is lower global activity, which we saw on the prior slide. But we're near the end of this cycle. Not quite done yet, potentially, but we're near the end of the rate hike cycle. Let's level set. Where do we stand today? The S&P was up 3% in July and now is up 16.5% year to date. Outside the U.S., about half that. We think the U.S. market might be getting ahead of itself. If the international equity market is not kept up with the U.S., it actually lends itself to investment. That is, we want to own the stuff that's underperformed or has lagged, and international equities have lagged. The Federal Reserve raised rates 525 basis points a couple of times this year. Most of that tightening came last year, and we saw what the effect it had on capital markets last year, and the worst year for a 60-40 portfolio on record. So when the Fed's tightening, you can generally expect most assets, risk assets or growth assets, and stability assets, which are bonds, to do poorly, and they did. But the reason we're in the rally we're in now is, I think, because folks are seeing the end of the tightening cycle. Julian, is there a question?
Yes, that's a question on the Fed, and I wanted to ask you specifically. We received it the last few days, but your client is saying he keeps hearing about the Phillips curve discussion, saying that the rate should be more like at 9%.
Taylor rule says 9%, or just a bit under. The Phillips curve is probably not dead, but it's in hibernation. I would say this: the Phillips curve is a point in time, and it uses current data. The Fed is always forward-looking and trying to set rates where it should go. But yes, I agree, Julian. If the question was, should rates be higher because the Taylor rule says so? Yes. The Phillips curve would also indicate perhaps a higher rate, but it's not directly translatable into a Fed funds futures or a Fed fund forecast. What the Phillips curve does is relates tightness in the labor market typically to overall inflation. There's a couple of configurations. One has unemployment on one axis, and the other has broader inflation on the other. But it's those are the two tools, by the way. It's a great question, because if you want to understand what the Federal Reserve does, understanding what the Phillips curve means to them, which was the core of their framework until John Taylor invented the Taylor rule in a seminal paper back in 1992, those two together tell you a lot about what you need to know. That and where the real policy rate is. That is the 5.25 or 5.5. We're at 5.5 on Fed funds right now. Take inflation out of that, and you see what the real policy rate is. Those three things are are a comprehensive way to understand what the Fed's doing. So we use all of them. Good question. Let's jump right in now to current events. Try to get through that so we can get on to the cyclical update. There's a lot of dissonance. I started the conversation today by suggesting that the economic data is uncertain. That is, the outlook based on blue chip economists is somewhat uncertain. And here's just one example of that: GDP and GDI. GDP is gross domestic product. GDI is gross domestic income. They measure the same things, just from a different perspective. GDP measures the value of what the economy produces. GDI is what participants of the economy take in. GDP, as we know it, is pretty straightforward. It's the number that most economists quote. It's consumption plus fixed investment plus net exports plus government expenditures. It's basically the expenditure way, GDP-E, call it. GDP-I, or GDI, is the way of calculating economic activity using what folks participating in the economy take home: wages, profits, taxes, things of that nature. Those two things should be equal. It is a tautology that GDI and GDP are the same. Which one is the true measure of economic activity? Well, most folks would say, well, I only hear about GDP, so that's the true measure. But that's not true. There's a lot of different ways you can calculate economic activity. And right now, there's the largest divergence on record. This, by the way, the chart on the left here just takes us back to it's about 35 years of data. And you can see that GDP and GDI are basically fellow travelers. So GDI is the orange line, GDP is the blue line, and they have a very high R squared of almost 60% for the last 40 years. But now there's some divergence. GDP is telling you that the economy is doing just fine. GDI is saying, maybe we're in kind of a slowdown. Maybe economic activity is slowing. So even though these two measures are supposed to be the same, what we're seeing is a pretty historic divergence in the two measures of an economy, and one of them is probably right. So again, I'm just trying to highlight the dissonance in the economic data right now, especially in the national income and product accounts. That's where GDP and GDI come from. They should be the same, but they're not. Just to put a fine point on it, this goes back 70 plus years, and this is the difference in GDI and GDP. So it's 3.4% now. GDP and GDI are on this chart on the top, again, going back to 1948, which is the earliest data we have on record. But right now, we have the largest divergence. So I'm just trying to highlight how uncertain the economic environment is. Two sources of economic activity that purport to measure effectively the same thing are telling you two different things about what's going on. So the next slide is, again, in the light of current events, we're seeing some pretty significant data suggesting the economy is strong, so that maybe GDP is right and GDI is wrong. The GDP nowcaster, which you would expect this would be closer to GDP, it's calculated using some real-time data that is much more closely aligned to GDP. The Atlanta Fed's GDP now, which is a real-time indicator of next quarter's GDP, is suggesting we might be approaching a 6% GDP print in the third quarter. I think this is going to come down. It's more volatile than actual GDP. GDP now, the Atlanta Fed indicator is the blue line. Actual GDP is, of course, only reported quarterly. It's the green line. The last print was 2.4, but it's GDP now is suggesting we're going to have a much better outcome in the third quarter. And looking at the City Economic Surprise Index, which basically measures whether the economic data is surprising on the upside or is it surprising on the downside. That is, our forecasters getting it right. And generally speaking, the data has been coming in stronger than economists expected it. And you can see that in a strongly positive move in the City Economic Surprise Index. So I would just call this more evidence of a no landing. That is, the Fed is not getting what they want. The inflation is coming down, but getting from 9 to 4 or 3.5 is probably the easy part. Getting from 3.5 to 2, which is where their target is the much more difficult. And if you do see the economy continuing to produce above output numbers, that is, it's a positive output gap above the speed limit of the economy. Speed limit of the economy is 2.5. If we print 6%, then we're going to run into some resource constraints, and resource constraints are basically the primary driver of inflation. So the Fed needs to slow the economy down below potential GDP. Potential GDP, the speed limit of the economy, 2.5 plus or minus. We need to get there or below to take the pressure off of inflation, and the recent numbers are not suggesting that we're doing that. So I want to talk just for a few minutes now about probably the most important element of today's discussion, and that is what's different about this post-World War II cyclical environment than anything we've seen in the past. And the fact is, COVID is the answer, and the response to COVID. On the left side, you see what we're calling excess savings, and Julian's prepared a nice chart on that. We'll look at that in a second. The forbearance for debt repayments, particularly student loan forgiveness and things of that nature. All of these things, the excess savings were a result of all the fiscal stimulus and all the consumer support that was generated, not just checks, direct fiscal checks right to your bank account, but also other programs that supported the consumer during the slowdown, the COVID slowdown. Excess savings has been a huge factor. If you have additional money in the bank and you're not paying down your debts because you're in forbearance, you're going to be able to support the economy at a higher level. So excess savings and the loans, particularly student loan forgiveness programs, those were very helpful. The other thing is the labor market is quite strong. If you got a job and you're earning a wage and the unemployment rate is as low as it is, that's also very supportive, and it's a very unusual level. We're at near historically low unemployment rates. And why is that? And particularly, there's some composition elements. That is, older workers tend to be retiring while younger workers are coming back to the marketplace. As soon as the labor force participation rate gets back to where it was pre-COVID, the unemployment rate will invariably rise, because you have a greater supply of workers and the same amount of folks employed, and that is an increase in the unemployment rate. So all of these factors, the excess savings factor, the loan forbearance, and the strength of the current strength of the U.S. labor market have been supporting the consumer through the cycle much more so than any other prior cycle. But I want to make a very important point. They've stretched the late cycle out. They've delayed the turn in the business cycle, but the business cycle has not been repealed. Let's take a look into some more details here. Well, first thing we're going to do is say, what happens to GDP if you take some of these things out of the economy? A lot of this stuff is already priced into the forecast, what I call the blue chip or the Goldilocks forecast. But if you take these things out and there's a deeper reaction, a stronger reaction in terms of consumer pullback, and if the consumer is starting to feel a bit of stress, couple that with regional banks that are no longer lending at quite the same level pre-Silicon Valley, and you do have a recipe for potentially greater slowdown than what's priced in. Let's just take a look at what the economy does if you take out the three items that I've identified as being the primary differentiators between this cycle and the next. This is US GDP in the Goldilocks version. We had a 3.2 a year ago in the third quarter of 2022, second quarter of 2023, most recent 2.4. Pretty solid economic growth activity here. The third quarter is supposed to be coming in less than 1, although we saw some data from GDP Now that suggests it could be off this chart. But right now, most forecasts think will be less than 1, maybe go below 0 briefly. So a very short, shallow, not even a recession, and then back to positive, and then to a year from now, back to 1.5+%. So when you remove the COVID support, many of the items of the COVID support that, they're priced into this. But if you do get a worse than expected reaction to some of these, the removal of some of these reports, that if economists got a little wrong here, then you might see a recession environment like this. And just to compare the recession environment to the prior Goldilocks scenario, it's quite a substantial difference. This makes investing challenging, because we do know that some of these things are coming off. The student loan support feature, which is the forbearance, is ending on October 1st. Excess savings are being drawn down, and some of the data we've seen suggests that it might be gone by the end of the fourth quarter. All of these things, and the labor market does show a few signs of weakening, if not, at its core. We're at the margins, we're seeing more people return to the labor market, and that is going to push the unemployment rate up. So all the things that we've addressed that are different might actually cause a little deeper recession than currently forecast. I'm going to go on to the next chart unless we've got any, there's a lot of questions rolling in, and maybe Julian will be able to consolidate them into some broad themes in coming minutes. The consumer is 70% of the economy. And on the right-hand side of this of the chart, you're seeing consumer delinquency rates. All loans, consumer loans, auto loans, mortgage loans, credit cards, whatever, delinquency rates peaked in the great financial crisis at 4.5, 4.75. But during this period of ultra low interest rate environment that we saw a spike during COVID. There was a lot of delinquencies, but then we got to very low levels with all the support. But we're ratcheting back up. We're not back to sort of pre-COVID levels, plus or minus, maybe we are, but we're not in a low interest rate environment anymore. In fact, we're in the exact opposite of a low interest rate environment. That's going to put more stress on debt service. It's much harder to service your debt when you're paying more in interest. So we expect that the consumer delinquencies are likely to rise. It's the canary in the coal mine, as far as we can tell. On the left-hand side, the lifeblood of the U.S. economy is credit and bank lending. And this is just a senior loan officer survey where the Federal Reserve basically asks all the senior loan officers in the banks across the country, are you tightening lending standards or are you loosening lending standards. Tightening lending standards means lower credit provision, less funding for projects in the economy, and it means slower economic activity. Well, there's a substantial hike now, and we were seeing some pullback in lending at the beginning of 2022. It's sort of accelerated since SVB, Credit Suisse, and all the regional banking crisis that we saw here. But these two things are not, they're a little tricky we can't extrapolate them, but they have some worrisome implications for the economy, both in terms of business fixed investment, which is a big chunk of the economy, and for the consumer, which is the largest chunk of the economy. Here's excess savings. Maybe many of you have seen these charts. They're pretty popular in the press. This is the personal savings rate, and then this is the pre-pandemic trend. So excess savings is defined by how much did the savings rate increase over and above what we would have expected in terms of a trend line. And the answer is there was about $2 trillion. This green blob here suggests that there was over $2 trillion of additional money that was made available to consumers through many of the COVID support projects that allowed the consumer to basically continue to spend even through the brief COVID recession. But since June of 21, for the last 2 years, the most of the programs have ended, and now you're seeing a drawdown, and you've seen 2/3 of it being drawn down already. So there's about 500 billion left of excess savings. This is as of May, so the number is probably closer to 400 billion now. And as a result, we think this is going to go away by the end of the year. If the excess savings is depleted, that removes a pretty significant support for the consumer, which again is a pretty large part of the economy. So we're keeping an eye on this data because we do think it's one of the major factors that differentiates this cyclical environment versus another. The makeup of the labor force post-COVID. So this is labor force participation of the prime age workers, so 25 to 54. And down here, you've seen basically a flatlining of the US labor force participation rate for 55 and over. So the Great Resignation, where workers are leaving permanently, and that's just retirement, is something that is sort of unusual, and we didn't anticipate it. But the most important number to know is prime age workers are back to pre-COVID levels. So people are returning to work. Why? Because their excess savings are running out, because the loan forbearance is ending, and because they need to go back to work to stay in their apartments and houses, et cetera. So we're watching the labor force very closely in conjunction with excess savings and bank lending. I'm going to move on to another item of current events. That would be the Fitch downgrade. And does it matter? The answer is not in the short run, but it does in the long run. So debt levels here in the United States versus today, which is what we see here, versus 2011. 2011 is the gray numbers. 2011 debt to GDP in the US was 92%. US debt to GDP now is close to 119. It was 128%, but it's coming down. But it's much, much worse than it was 12 years ago, the last time the U.S. got downgraded by S&P. In August of 2011, we got downgraded from AAA to AA+. Beginning of this month, same thing happened at Fitch. Fitch downgraded the U.S. from AAA rated to AA+. Does it matter? The answer is, this is what a Fitch analyst, I used to be the sovereign credit, global sovereign credit analyst at UBS. So the debt sustainability, fiscal metrics, debt levels, the things that you look at to assess sovereign credit and the quality of the sovereign's credit, there's 6 or 8 of them here. And the most important ones are going to be debt and deficits, because of course higher deficits lead to higher debt. You got to fund your deficits. Deficits aren't as bad as they were in 2011. They're only we've got a current budget deficit of -5.5 versus -8. And the other thing you look at besides the debt level is how much is it costing you? So the deficits tell you how much the debt's going to grow. And then this metric, the average cost of the debt, tells you how much your debt service payments or your interest expense on debt is. And pretty soon we're going to have to start issuing debt just to make interest payments. And Hyman Minsky would call that a Ponzi unit. If you've ever read Stabilizing an Unstable Economy, if you haven't, it's a great book to describe how countries get into difficulty by overloading by being over levered and increasing debt levels. right now, the US is paying about 2% on average. 10 or 12 years ago, we we're paying almost 3%, but this number is going up. It's going to 4 because this works on a lag. This is the actual average coupon interest that the Treasury Department's paying on US Treasury securities now. With metaphysical certainty, it will be much higher a year from now because interest rates are much higher and you're rolling the debt over. You're rolling low coupon interest rate debt over into higher coupon debt. So the US downgrade was due to a couple of reasons: deteriorating fiscal metrics and the result of the debt ceiling nonsense that went on in Washington a couple months ago. It's just nonsense that we should have to deal with that. So the political dysfunction was also listed by Fitch. Julian, question.
Yeah, I'm not interrupting you much because I know you're going to address most of the questions with the next few slides, but there are specifically questions about, if you had to forecast in 10, 20 years out, the US dollar still being the reserve currency. I guess we're getting there. So you want to address that one, and, the BRICS trying to come out with their alternative currency. Do you see that as a challenge?
No, the latter question, no. To be a reserve currency, you need deep and liquid capital markets, and you need to have the rule of law, and you need to have institutions that are credible, like the Federal Reserve and the Treasury Department here in the US. And it doesn't just happen overnight. It takes a generation or more for these things to become stable enough and mature enough to take on the mantle of world reserve currency. So what we're looking at on this slide addresses, the ubiquitous nature of the dollar. The dollar is used in most international transactions, and almost 60% of global foreign currency reserves, that is, the reserves that other central banks use to both stabilize their currency and for other internal purposes, is the US dollar. It's not the renminbi, it's not the Japanese yen plus the Great Britain pound. Yen plus pound is only 10%. The euro is about 20% of global foreign exchange reserves, but the US dominates and will continue. Just because somebody announces something doesn't mean it means anything. The most important metrics for determining your reserve currency status are you the largest and most stable economy? Is your currency supported by mature and, frankly, responsible institutions? And if so, and do you have a strong Navy to keep shipping lanes open? That's probably the third thing. If those things are true, then you will be the reserve currency, because people will use you as in international trade, and they will use your currency in foreign exchange reserves. And there is no credible substitute right now to the US dollar, and it doesn't look like there's one. But I said on the last slide, at the top of the last slide, no, I didn't. Where is that? Here, oh, here it is. Reserve currency status is a privilege. It's not a right. You can lose your reserve currency status, and we are heading in that direction given the political dysfunction in Washington about the debt ceiling. It's a silly law, it should be repealed. And because we haven't been able to figure out a way to balance the budget, because there's not enough, frankly, courage in the political class right now to make the necessary adjustments to the fiscal balance situation. So the federal budget deficit needs to be balanced, at least from a primary budget balance. That means X interest costs. But right now, there just doesn't seem, or we need to grow our way out of it. We need a growth rate that's higher than a real growth rate that's higher than the real cost of the debt. If you have a higher, that'll get your debt to GDP down by definition. If you have faster GDP growth than the interest you're paying on debt, by definition, you'll reduce debt over time. So we need to grow, but we also need austerity in terms of government expenditures to reduce the budget deficit. So those are very difficult decisions to make, how you balance those two things, because they're competing. The most important thing you can do is probably inflate your way. Well, the most efficient way to reduce debt levels, your real debt burden, is to inflate your way out of it. So I wouldn't be surprised if inflation was a little bit stickier than it was for the last 20 years at something above 2%, maybe 2.5%. If you're even at 2.5% inflation, we're at 3.2 right now. If you're 2.5% inflation, you can pay down the debt that you incurred in the last 5 years. That number stays static. That number doesn't grow. But the GDP that you use, that's your income. If you're a country, GDP is your income. Nominal, your debt levels are, the national debt. You can pay down the national debt using inflated GDP. as years roll by and you inflate your tax receipts using, just by letting inflation run a little bit hot. That's part of the financial repression thesis that we've articulated many times over. It's part and parcel of it. And it's how developed countries do it. Emerging market countries can't do it effectively because they typically borrow in hard currencies. Brazil borrows a lot of money in reais, but they also borrow a lot of money in US dollars, Turkey, China, et cetera. You can't do it if you issue debt in your own currency. You can do it if you issue debt in your own currency, and the US issues only in US dollars. So we have the pole position in the reserve currency race, and we'll continue to maintain it, but it is something that needs to be protected and preserved. So we do need to do things a little bit differently, and Fitch was just highlighting that in their recent note. What about China? China, the reopening story was supposed to be a big one for 2023, and it's not happening. I'm just going to touch on this very briefly. China debt levels are much higher than any other emerging market by far, and China debt levels, this is total economy debt. Total economy debt in China is 3.5 times GDP. It's over 3.5 times GDP, 360%. It's a ticking time bomb, actually. And they have the highest level of debt. Now, it doesn't mean they're going to have a crisis. A crisis is not a foregone conclusion just because you have high debt levels, because you have to look at the asset side of the balance sheet too. And because the banks in China are government owned, a bank run is not contemplated. It's as it is here in the United States with privately owned banks. Plus, China has trillions of assets that they could sell to pay down debt, trillions of state-owned companies, petroleum companies, aluminum companies, steel manufacturers, et cetera, et cetera. The banks themselves, they could sell a lot to pay down debt if they needed to. So the asset side of the balance sheet is the flip side of the debt. And they have a lot of assets that could be liquidated to improve their debt position. So it's not a foregone conclusion, but it's something to highlight, especially in light of the Country Garden nonsense. Country Garden was the largest, now it is not, was the largest property development company in China for much of the last 15 years. So Country Garden stock price in Hong Kong dollars went in the last 2 or 3 years, went from 10 to less than 1. They're on the brink of bankruptcy. The largest property developer in China is on the brink of bankruptcy. Now that could that could be the fuse that lights the debt bomb, but probably won't be. It's probably going to get contained, but it's something to keep an eye on because they're close to bankruptcy. And whether or not the Chinese government will continue to support them, they will provide support. Will they save them? Probably not. The key issue here is that a property crisis in China could spill over to other parts of the Chinese financial system. And should China show a significant slowdown, that will dampen risk-taking globally. So the real transition here is Country Garden is in distress. It spills over to other areas of the Chinese financial system. It slows economic growth in China like it has. And then you have risk aversion in other places. The linkages between China and the US are strong. We have a lot of trade linkages, and the other metric is through the foreign exchange mechanism here. And here's the forecast for China real GDP. It's all positive right now. The outlook for China GDP, 1% kind of on average for the next 4 or 5 quarters. But you can see they're already seeing potentially they're headed for deflation. This is certainly disinflation. GDP on the left, CPI on the right. And what you've got is right now, China is actually flirting with zero inflation. If you get zero inflation or below, if you get a deflationary environment with a high debt level, I mentioned earlier, if inflation is good if you're an issuer of debt, because you can pay down the debt in inflated dollars. The opposite is also true. Deflation is horrible for someone who issues debt, because now deflation means your income to service the debt is decreasing while the debt levels stay the same. It's the opposite. And so what I'm looking at in China right now is the debt deflation and the potential for an increase in their overall real debt burden because prices are declining. It's why deflation is such a nefarious. Everyone has debt. Every country has debt. Most companies in the U.S., a lot of companies in the U.S. have debt. Deflation when you are heavily indebted is a pernicious situation. It can turn into a death spiral basically for the company, or in this case, a country. Probably won't for China. China's got, as I said, a lot of assets, and they have a lot of levers that they can pull to support the economy. But right now, it looks pretty grim. Okay, finally, 40 minutes in, we're into the capital market update. So the S&P. this is why we talk about all this stuff. What's the stock market going to do? What has it done? Here's what it's done for sure. The peak on January 4th, 2022 was almost 4,800. Then we had, until October 12th, this steep decline. Don't sell, you never sell. Since that decline, we're up, 25 or 30%. Then you had this, rally until August of 2022. And then you had more fears of Fed rate hikes. So the stock market sold off 17%. And then in October 12th, I think we had the most recent local low of 35.77. Since then, we're pretty much blowing right through it. We went through this breakout level right here, and the equity market continued to power on. Earlier this morning, we're at 44.07, which was up 14.5% from the other local low I'm highlighting, 38.55 here. So what are we seeing? We're seeing a lot of volatility in the stock market. This is a lot of volatility for a year and a half period. And it reflects this tug of war between recession fears and Fed rate hikes. Recession, not full-on recession, but really more soft landing. That is, the Fed's done. If you can say the Federal Reserve is done, the stock market rallies. If you think the Fed's going to tighten more, the stock market sells off. So fears of Fed rate hikes is what's been driving the equity market down. And lately, fears of a Fed pivot that they're done are driving the equity market higher, at least until beginning of this month. But since the beginning of this month, we're off a couple percent. Why? Because inflation bubbled up, and it doesn't look necessarily like the Fed is completely done. So just looking back to these levels, total return basis being up, 1,000 points, pretty nice from the October 22 lows. And I just want to highlight how resilient the equity market has been. They've completely shrugged off additional Fed rate hikes. So the market is not taking it very seriously. And I think part of the reason is the stock market does not have enough respect for how Fed policy or monetary policy tightening works. It doesn't work instantaneously. Where's the recession? Everyone's been asking. And the answer is it's coming. We just don't know when and how deep it is. But the business cycle has not been repealed. A slowdown is coming. Whether it turns into a recession or not, probably be my base case, especially if we start with a no landing scenario. No landing means no slowdown, and the Fed has to act more aggressively. We'll talk a little bit more about that in a sec, but the equity market's been incredibly resilient. So here's the mea culpa. For the last 9 months, I've been saying 424 was the peak on 10-year yields. As of today, 10-year yields breached 425. And right now they're about 430, plus or minus. 2-year yields, you can see the transition of 2-year yields. 10-year yields are the purple line. 2-year yields are the orange line, and Fed funds is the blue. So you see where all the Fed rate hikes were here, and the peak of Fed, peaks are circled here. So it looks like 2-year yields might have peaked at 507 right before Silicon Valley Bank implosion. It looks like 550 might be the peak. It's a question mark. We could go to 575. That'd be one more rate hike. We could go to the peak here. We got to take the peak off of here because we've hit 430. Is that the peak? 431, that's where we are today. Could go to 450, could go to 4%, we don't know. But certainly the peak of 2-year yields is likely to be here. And this is what, you have a lot of bond market vol. It's the same thing. It's what's happening in the equity market. The interest rate markets are even more inextricably linked to Fed funds and to Fed policy, especially 2-year yields. So 2-year yields, when you have fears of Fed rate hikes, 2-year yields go up. When the Fed's pivoting or going to lower rates, 2-year yields go down. So that's all we're showing. This is late cycle dynamics, high volatility of interest rates, much higher volatility in interest rate markets than there is in equity markets. And we're just trying to figure out where the peaks are. And right now we're having to revise our views. Question, Julian.
Yeah, on that note, where do you expect the 10-year Treasury yield to go? 4.5%, perhaps 5%?
Not 5. We could easily go to 4.5. We're in striking distance to 4.5 now, but it all depends on the economic data. So if you tell me what kind of landing we're having, in a no landing scenario, we could get above 4.5.
And then I guess it goes together. So, if rates keep going higher, why do you hang on with Treasury? Why would you want to own bonds when rates keep going higher?
Because we can't predict when the recession is going to occur, and the recession will be lower and deeper and longer. if we have a no landing scenario. So right now we have a small allocation to adding a half a year duration plus or minus to the portfolio. And that was done ahead of the debt ceiling crisis and when recession probabilities were higher. Do I think the recession probabilities haven't modified dramatically? And in my view, it's just economists responding to more positive data in the current environment as opposed to looking 2 to 4 quarters ahead. Our job as investors is to look 2 to 4 quarters ahead and and then nudge the portfolio around a little bit. If we're wrong on the interest rate bet, it wouldn't be the first time I was wrong, but it highlights the fact that we care more about longer term returns, 3-year returns. I mean, we can't really be judged yet on a bet we put on, 100 days ago. We added interest rate risk 100 days ago and rates are up 60 or 70 basis points since then. So that hasn't worked out, but like any good portfolio manager, and I say this with tongue in cheek, we're probably early, but not necessarily wrong. So we'll see how the rate environment evolves, but you want to own long duration treasuries if the economy is going to slow. The economy has not slowed yet. I don't know exactly when it's going to slow, so I want the long duration bet on as a hedge, it'll be a bonus when rates decline. When they do decline, having that position on will work out. But look at overall portfolio results, not just one line item. That's the key. Okay. Oh, and just to put a fine point on it, our view was that 425 was the peak. That's why we put the bet on. So clearly wrong about that. But where we go from here is all that matters. That's in the rear view. That's ancient history now. We've blown through 4.25. Now what do we do? Do you take the bet off because we've been proven wrong? I think the thesis remains intact that monetary policy works on long and variable lags, and we have not seen the full effect of the Fed's tightening program. And just to be clear about that, the Fed doesn't even need to raise interest rates higher for it to continue to tighten financial conditions in the economy. All they have to do is see inflation come down a little more. As long as inflation comes down, the real interest rate rises, and it's real interest rates that matter for the US economy. That is inflation adjusted rates, and they are the highest they've been since the creation of TIPS products, 30 years ago. We haven't seen above 2% real yields in a very long time. They will constrict economic activity by definition, but not immediately. It takes 2 to 4 quarters for tightening financial conditions to affect the US economy. So why are interest rates going higher? Here's the biggest reason, probably, not the downgrade, but because of increased supply and budget deficits. So and like supply and demand economics 101, if you have higher budget deficits, and we do, and you need to fund them through debt issuance, you got to plug the funding gap by borrowing money. So the Treasury issues more Treasury debt. More supply pushes the price of something down. In this case, Treasury bond prices are going down. What happens when bond prices go down? Yields go up. So with this new kind of $1 trillion issuance level for the third quarter of this year, and with 800 billion plus issuance over the course of the next couple of quarters to fund the budget deficit, it seems increasingly likely to me that this supply is going to continue to provide at least a floor. May not continue to push rates higher, but it'll put a floor under rates. That's one element. The other element, we can't ignore the fact that the US interest rate environment is also tightly linked to the global interest rate environment. So we have global interest rates going up. Japan just announced, this is Japanese dollar bonds, or Japanese yen bonds are in the orange. The US is gray and Eurozone is in green. There's been a significant spike across all global interest rates. Here's a tighter shot of Japan for the last 5 years. Japan had this yield curve control policy, still has it, but they've loosened it since 2016. In 2016, the Bank of Japan said, we're going to lower interest rates using effectively quantitative easing type policies, but we're going to target the interest rate level. We're not going to target, 10 trillion yen of bond or 100 trillion yen of bond purchases. We're going to target the interest rate. And they were going to keep 10-year yields in Japan between plus and minus 50 basis points of zero. So here's the yield curve control bands, plus or minus 50 basis points. This is zero here. In the last couple of weeks, Japanese yen yields have risen dramatically because of announcements from the Bank of Japan that suggest that they're going to use yield curve control as a guideline, not a rule anymore. So with international interest rates going up, and these rates are highly correlated, on the order of 70+%, when you're looking at 10-year yields versus German yields or Eurozone yields and Japanese yields, they're highly, highly correlated. So if they're going up outside the US, they'll go up in the US as well. Last thing I want to say about interest rates before moving into some other, the cyclical environment, this is the yield curve. The yield curve, depends on which curve you're looking at, but we're looking at two. The green is 10-year minus Fed funds. That's the one that is a better predictor of a recession. This is data going back about 35 years, 40 years now plus. And every time the green line goes below zero, you get a recession. Not so every time, the orange line does. You don't necessarily. The orange line is two-year treasuries minus 10-year treasuries. The green line is Fed funds, Federal Reserve policy rate minus 10 years. Both of them are yield curves. Both of them are deeply inverted, as you can see in this chart here that goes back a couple of years. The inversion of the 3 months to 10-year, or the Fed funds minus 10 years, was 170 basis points, one of the steepest inversions in history, and a strong signal that we were having a recession. As the curve inverts more, it increases recession probabilities. As the curve flattens and then goes positive like it normally is, the curve is normally very positive. That is, you get paid more for a 10-year bond than you do for a 2-year bond or for a 3-month T-bill. That lowers recession probabilities when things are moving up. And what you've seen is a pretty significant move, primarily driven by 10-year yields rising pretty dramatically. So you've seen a significant reduction in the probability of a recession, but it's still flashing maybe yellow, almost red, because minus 100 basis point inversion is still pretty massive. So the yield curve is telling you something. It isn't, determinative, but it still says we're headed for maybe rough economic waters. I'm going to go right to the Fed and inflation. And there's a quote here from the Jay Powell's Jackson Hole speech last year. Basically, it's talking about economic sacrifice ratios. That is, he's saying that there are unfortunate costs in terms of slower growth and higher unemployment that are needed to bring down inflation. We just haven't seen either one of those things yet. So I just want to highlight that. Julian, is there another question?
Obviously, there's a lot of questions on Fed and inflation, and just wanted to frame some of them. Like, one is what's the magic behind the 2% target, and would the Fed be satisfied and with something in around 3?
2% is what the Fed has determined is the number that it gives them some freeboard above deflation, and is low enough. It's high enough to give you some buffer between to zero. As we mentioned, the worst case scenario for a central bank that is in the country that has debt is deflation. So you don't want to set your inflation target at zero, because the next exogenous shock is going to take you into deflation. And that's why 2% is the number. It's high enough to give you some freeboard or some buffer to zero, but it's not high enough to influence dramatically consumer and household and business financial decisions. The neutral rate of interest is the rate of interest, the monetary policy rate, R star, is the interest rate that doesn't affect decision making dramatically, doesn't support the economy, doesn't put downward pressure on the economy. And the Fed thinks that's 2% nominal. And that's why they target 2%. 3%, and maintaining a 2% target has another very, and articulating it, communicating it, broadcasting it, which they did officially back in 2012. Before 2012, it was just kind of understood that they were shooting for 2%, but it wasn't official. But it's now officially part of the Fed's framework, policy framework, 2%. By highlighting the 2% target, the Fed basically improves its credibility as an inflation fighter. We have a target, we're going to maintain it, we're going to do everything we can to stay there, we're going to get back there when we move away from it. And now with flexible average inflation targeting, we're going to push it up when it's below, and we're going to average inflation, and we're going to push it down hard when it's above. But we're going to average it over an undetermined period of time. 2% is the number. It's the right number for promoting economic growth or not in the economy. It's neutral. And it also establishes the Fed's inflation fighting credibility, which makes their job easier. If you know the Fed's got a specific target and you can measure it, the Fed will be more accountable. And a more accountable and independent central bank is a better central bank. They don't have to raise rates as high to push inflation back down because they have credibility. So they just raise rates a little bit and then talk tough. That's why you have a 2% inflation target. 3% wouldn't do it. If you went to 3%, you would see a loss of inflation, Fed bank, central bank credibility, because, oh, you can't move the target. It's like being a portfolio manager that says, oh, well, I didn't beat your benchmark this quarter, but here's another benchmark and I beat that one. You lose all credibility if you don't have a stable, defined metric for success, and then stick with it and be accountable to it. So the Fed is not going to move. They're never going to make an announcement that says, we're going to let inflation run hot and we're okay with 3 or 2 3/4. They will be okay with 2.5 or 2 3/8 because it's close enough. And it also helps reduce the real debt burden. Okay, inflation, where are we? Well, ticked up from 3%. We were actually at 3% 2 months ago. Last month, we got a 3.2% print, okay? This is core. Core is below 5, but headline CPI inflation, which the Fed doesn't really care about as much. They care about personal consumption expenditures, but everyone talks about consumer price index or CPI. So we're going to look at it. It's 1/3 what it was a year ago. So, but it's well above the Fed's target and in the kind of the danger zone here. So core inflation is lower. They care more about core type numbers because they're stickier, and that's really well above the 2% target. So here's where we are and where we're headed. What does the Fed really care about? Super core. Somebody probably asked a question about CPI core services ex housing, which is basically super core. Super core is lawyers, plumbers, haircuts, stuff like that. That isn't. It's a pretty small chunk of the economy when you're measuring price movements, but it's big enough and sticky enough for it to be the most important thing to Jay Powell, which makes it important to us. So what's happening with supercore? Well, the blue line here is just headline inflation, same number you saw on the prior page, peaked at 9, now at 3. Supercore peaked at just under 7 and is at 4% now. And the reason the market had a little bit of a wobble in August, I think, is because supercore kind of ticked up a bit. So supercore, which is the number one, metric quoted by Jay Powell, he almost talks about it and nothing else, was moving decisively lower. But in another element of, the no landing scenario, it's not going to be a linear ride all the way back down to the 2% target. We're going to have fits and starts, and that's indicative of a no landing scenario. The Fed would like this number to be back at 2. All inflation numbers, particularly personal consumption expenditure deflator, the PCE core number, that's the one they focus on. They want to see that. That's at 4% right now, plus or minus. That's the number they need to see at 2. It's double what it needs to be. Last point on the Fed, and then there are more questions. Expected long-term inflation is the number one measure of the Fed's inflation fighting credibility. It's not the actual inflation number. It's what market participants think the Fed's going to do over longer periods. And they measure that by the inflation expected in years 6 through 10. So between 2028 and 2032, inflation by this measure should be 2.3%. That's a little higher than the Fed's 2% target, but it tells you that they are a credible inflation fighting central bank, and they need to maintain their inflation fighting credibility. When inflation expectations, and remember, these are longer term inflation expectations, they're not the data that we're getting from the BLS. This is measured by the TIPS market, the Treasury Inflation Protected Securities market. And at one point, we were approaching 2 3/4. So a well above 2.5% inflation expectation. And guess what? This coincides almost precisely with the Fed's incredibly aggressive rate hiking cycle to smash this number back down to something closer to 2. We're at 2.32, it ticked up. So the Fed is going to, if this number continues to rise, I guarantee you the Fed will raise interest rates again, because they will want to maintain their credibility because it makes their job easier in the future. They won't risk losing inflation fighting credibility. Julian.
Yeah, one question just about how should we think about the averaging period, for calculating the 2%, the Fed's 2%? How do they think about it? Because they don't really want to define it.
Well, they define it as personal consumption expenditure core deflator. And it's very specific.
But the period itself, the averaging
Oh,
period.
yeah. Oh, yeah. Okay. So August of 2020, Jay Powell at the Jackson Hole speech. There's no Jackson Hole's next week too. They're going to get together and talk about stuff, and it's going to be in the press, and there'll be something coming out of there that someone will latch onto. But 3 years ago was a very impactful speech by Jay Powell, where he introduced flexible average inflation targeting. They do not want to lose their degrees of freedom. They want maximum optionality, maximum flexibility to set monetary policy, because the conditions are going to be different. Why is inflation higher this time versus 40 years ago versus the next bout of inflation 20 years from now, or whatever, or 10 years from now, or 5 years from now? So the environment is always different. The impulse to inflation is always different. So the Fed wants to be able to respond to it in many different ways, and perhaps over longer periods or shorter periods, or hiking rates faster, or leaving them higher for longer. They want maximum flexibility. They will never, ever let themselves be pinned down by something like the Taylor rule, which is an automatic, hey, Taylor rule says you need to be at 6, we're going to 6. Taylor rule says 4, we're going to 4. Whatever. They don't want to be nailed down by any rule, including flexible average inflation targeting. They announced flexible average inflation targeting at a period of time when inflation was well below. The 10-year PCE core average was 1.68 for 10 years prior to August 2020. Since then, PCE core, of course, is averaged about 3% for the last 3 years. And it's going higher because the numbers are still higher. So the Fed does not want to be, they do not want to be constrained, so they will never announce exact metrics for the rule. But by announcing it, they were basically saying we need to get inflation up too. That was way before. That was a very quaint period prior to this massive inflation impulse we've seen. So just going back, 3 years, it's hard to recall that the problem the Fed had was inflation was too low, and flexible average inflation targeting was announced to deal with that. In the current environment, on this slide, this is the slide, by the way. If you don't know anything else about what the Fed does, just memorize this slide. This is how they fight inflation. They tighten financial conditions. How do they do that? Increasing interest rates, reducing the S&P by raising interest rates, widening corporate bond spreads. All of these things are going to slow the economy and reduce price pressures, and it works on long and variable lags. We just don't know what those long and variable lags are. Finally, on the Fed, right now, this is the real policy rate, the real Fed funds rate as deflated by their preferred measure, the PCE core. We were never as loose as we were back in April of 2022, when the Fed embarked on this path of tightening. And we're well above neutral now. The Fed policy rate is 1.25%. And that just tells you that, policy works long and variably. We don't know. This is going to start to bite. We haven't seen the impact yet. That's the main point of today's conversation. The business cycle and the impulses to the business cycle, the three things we identified: excess savings, dislocations in the labor market, loan forbearance, et cetera. All those things have stretched the business cycle out, but they haven't repealed it. I do believe we're going to get some kind of a recession, but I don't know what. I am going to jump to cyclical dynamics, take a few minutes and talk about what the scenarios look like. They're likely to fall into one of these three camps. It's Goldilocks, soft landing. Most folks, at least 30 days ago, thought we were heading for a recession, just straight into a recession. And back in January and February of this year, my good friend Torsten Slok, who's the chief economist at Apollo, basically articulated a no landing scenario. The no landing scenario means economic growth remains positive and inflation stays elevated. Inflation's coming down, but it's elevated. Economic growth is positive. So I feel like we're kind of in a no landing, or at least it feels like a no landing right now. Whereas a recession, that's easy. Inflation comes down because we're in a recession and economic growth is negative. Soft landing is Goldilocks. It's the best of all possible worlds. Limited impact on the unemployment rate. Economic growth is low but not negative, and inflation continues to move towards the Fed's 2% targets. These are not mutually exclusive, by the way. In fact, I feel like what we're seeing today and what it feels like is a soft landing. What I think we're really getting is a no landing. First good, then bad. And so that means a recession might be in our future. So the defining feature, frankly, of a no landing scenario is economic activity that doesn't decline fast enough for the Fed to be comfortable that inflation is moving down to its 2% target. So what do they have to do? They have to raise interest rates higher. In fact, let's just jump to this is a stylized business cycle. We were here about a year and a half ago. Now we're in the late stages as of the last 18 months or so. And where do we go from here? This is soft landing. We don't have a contraction. That's recession. And no landing, again, just to put it in the business cycle framework, is kind of get a reacceleration or no slowdown in the economy. But that means the Fed has to raise interest rates a lot more, and that creates a harder landing in the future. So here's what GDP looks like in each of these scenarios. This is Goldilocks. It's the blue chip forecast. The blue chip forecast for both GDP, which is what we're looking at here, for the Goldilocks forecast is a mini recession. Not even a recession, it's just a mini slowdown. In the no landing scenario, you don't get that until later in 2024, because by 2024, the Fed's raising Fed funds to a much higher level. Whereas a recession, the economic activity just goes off a cliff. That's a garden variety recession, no problem. Lasts 3 or 4 quarters, and then we're done with it. Here's the inflation forecast for Goldilocks. It's a gentle decline. The no landing, you get quite a bit of stubborn inflation, which means, and inflation in a recessionary environment just also off the cliff. So here's what happens to the Fed. This is the most important chart right here. If the Fed is done, and that's kind of where we are in the blue chip, or, there's very little probability of a Fed rate hike priced into September. It's slightly higher between now and November, but it's still less than 50%. It's close to 30% between now and the end of the year. So the Fed is done in the Goldilocks scenario. In the no landing scenario, we got to go up another 50 basis points or more to get to 6% Fed funds. Whereas we're certainly done in a recession scenario, and the drop in Fed funds is much faster. Each of these 3 scenarios for GDP, inflation, and Fed funds argues for whether to invest in a couple of different ways. And that's where we want to end, I think, the conversation in the next couple of minutes. In a soft landing Goldilocks, growth assets look pretty good. Growth assets include equities, both domestic and non-US, and they also include high yield bonds. So growth assets in a soft landing look pretty good, but it means interest rates are likely to stay higher for longer and maybe move up higher. And in a higher interest rate environment, short duration is where you want to be, and alternatives. In a no landing, which is where we've been, and why I said you don't necessarily want to be in long duration, you want to be in short duration, but you want to be in alternatives no matter what, because you're capturing these risk premiums. The point is, the Fed has not been able to so far materially slow the economy. So where's the value? This is a slide Julian always prepares. It's a great one for equity market valuation. It's not a good trading tool, but it does tell you, if the world works like you can either invest in equities or you could invest in bonds, and it does, then by comparing the yield on bonds to the earnings yield on equities, you can establish a risk premium and see if it's trading at higher compensation for risk or low. This 6.2, by the way, occurred. That must be the fourth quarter of that's the COVID, immediately in the aftermath of COVID. So this is March of 2020 right here. Where we are now, a couple standard deviations below the longer term median. So compensation for risk taking in the equity market has declined, and it looks pretty rich, especially compared to 10-year yields. And that's not necessarily because equities have, the multiple's high, which means the yield is low, but it mostly is a result of much, much higher 10-year yields. Julian.
So I guess the question then is, if the value is so unattractive, is it time to flee? Or should we head out? What's the Beacon point of view?
No, I mean,
position on that.
So it's never, the only reason you should flee any asset class is because your personal risk profile has actually changed, not your perception of your risk profile has changed, or your liquidity needs have changed, in which case you just need to ratchet down the risk you're taking incrementally. But to go from, call it a 60-40 or 70-30 allocation to zero equities, no institutions would even contemplate that, because they have a long-term investment horizon, and so do you. Your investment horizon is longer than you think. And suffering through an equity bear market is worth it to be able to get the upside. Bear markets don't last very long. Bull markets are how you build wealth. We'll see a chart on that in a second. But just because the equity market is undervalued doesn't mean we think a crash is coming with any degree of certainty, because the one thing we have learned, and we must be humble about, is forecasts for the economy, inflation, and the capital markets come with a high degree of uncertainty and a very wide error band. So the one thing you know for sure, though, is you do need, over the next 5 or 10 or 20 years, to have equity market exposure in order to achieve your financial objectives. You cannot retire on cash. You cannot retire just owning bonds. If you're already in retirement, reduce your equity exposure. Don't eliminate it, because your horizon remains, in most cases, decades. And if not for you, for your legacy assets. So no, fleeing is not an appropriate response. Ratcheting down risk slightly. We're neutral risk because I don't know if the equity market's going to keep going up. Thank goodness we're neutral and not underweight. I was pretty negative, really, about the valuation of the equity markets for the last 6 months. But if we'd taken off equity risk, we'd be way underwater. So the level of your conviction matters a lot. And right now, you don't flee because your level of conviction in the late cycle has to be very low. That is, the uncertainty level has to be very high. Julian, what's the next question?
Just about the banking sector specifically, because we talk about equities in general. And I guess what's your view about, I guess, investing in bank stocks? And the other one is just having your money at the banks. Is it safe? Which one? Can you leave your money at the banks?
Yeah, you can leave your money in the banks. The banking system is safe and sound. Will there be a run on the bank in the future? A bank, specific bank? Yes. Will the government support it? Yes, because they can. And there is no alternative. What are you going to do? Buy gold, put it under your bed? The banks are safe. Doesn't mean they're all going to be here 10 years from now. They won't be. So that goes to the investing question. The investing question in bank equities versus leaving your money at the local community bank are two different things. As long as you maintain balances below the FDIC minimums and you don't get above, and even if sometimes if you are above, you're going to get indemnified by the government. That's what we saw in March. It's not guaranteed, but no, the government has ways to smooth through panics. Goes back to the fleeing question, by the way. Fleeing the equity market because you're thinking it's going to go down. Fleeing your deposit, by taking your deposits out of a bank, fleeing the bank. These are emotional responses to a world that doesn't reward emotional responses. In fact, it punishes them pretty meaningfully. So the key is to understand what it is you're trying to accomplish on the long term, and then set a plan, find an advisor that understands your goals and objectives and can help manage you through the inevitable wiggles so that you can capture the trends in the market. You want to capture the trends. You don't care about the wiggles. Question. Okay.
So you convinced me on the equity side of my portfolio, but what about my fixed income side, all the cash I have? I mean, I can make 5% just in CDs or with treasuries. So why would I go buy bonds or high yield or private credit?
It's a good question. And the answer has to be cash rates fluctuate with economic activity. So you're exposed to some pretty meaningful reinvestment risk. If you own a 3-month T-bill at 5%, which is about what you can get right now, 5.10 maybe. 3 months from now, what if interest rates are 4.50? 8 months from now, 9 months from now, what if interest rates are 4? 12 months from now, what if interest rates are 3.5? That's a reasonable, that pretty much matches the Fed funds futures. The market is telling you short-term interest rates are going down. So when you need to roll over your T-bill or you need to invest your cash into something else, will you be willing to do so? And the answer is no. And the other answer is bonds, which, by the way, per this chart, this is real interest rates on bonds. It's your only valuation metric you really care about when looking at treasuries. What's the real yield? Pretty darn attractive. We haven't been here since, 15 years, 18 years since we saw these kind of real yields. Bonds now provide enough of a real yield to be a hedge against growth asset declines. If equity markets go down, a year ago, 18 months ago, when equity markets declined, interest rates were at historic lows, 200-year lows a couple of years ago. They provide no hedge when yields are that low. Yields are attractive. Bonds now provide a hedge. Cash does not provide a hedge and should not be part of your retirement. Cash is for short-term expenses and for liquidity for known purchases, but it has no place in in a professionally managed retirement account, whether you're a private client, and institutions don't even ask that question because they know they have a long-term investment horizon, and generally speaking have the fortitude to manage through some of the short-term wiggles. Private clients should too. Private clients should be confident that the market is not ending. The world is not coming to an end. It never is until it does, in which case we got bigger problems. So don't worry about it. Know that the stock market wiggles. Ignore them. Get the trend. What else, Julian?
Yeah, Michael, maybe going through the sub-asset classes in fixed income. What about munis? What about high yield, corporate bonds? How would you allocate duration and credit risk?
So right now, you're not getting compensated. So there's two components to owning corporate bonds, whether they're investment grade or high yield. And then I'll talk about munis in a sec, because munis have some credit risk too. The two components of a corporate bond are the risk-free rate, which is the treasury yield. And we talked about valuations in treasuries. They're beneficial. That is, real yields are high. Add on to that a spread. Corporate bonds pay a higher yield than treasury bonds for a reason, because they have default risk. So you can measure the compensation for the risks that you're taking in corporate bonds by measuring the spread you're getting from treasuries, over and above treasuries, to the yield that you're being paid on corporate bonds. Let's just say treasuries are yielding 5% and corporate bonds are yielding 6.5%, plus or minus. What that's saying is that you have about a 1% default rate embedded in your corporate bond exposure. In a recession, corporate bond default rates might be higher than that. So you're not necessarily being compensated if you think we're going to have a recession. So we're not adding credit risk to the portfolio. We're neutral credit risk. Same with munis. Munis they act more like treasuries because their default rates are incredibly low, but they do have some modest credit risk. It's not unheard of to have a municipal bond default. It's rare, but it's not unheard of. So municipals, I think, more of like in treasury land with a little bit of credit risk. And they're attractive too because of the argument I just made, because of this argument. We're at 1 3/4 real yield on treasuries. This is 10-year real yields. It's the nominal yield minus inflation. Inflation expectations, importantly, inflation expectations for the next 10 years. Yeah, no, nominal interest rate you're getting paid right now to own treasuries and munis, and to a lesser extent credit, because the spread's not wide enough. So that's how I differentiate the fixed income markets.
Another question that's interesting. If you're a US-based investor and you're worried about being too much tied to the US fiscal situation, what is there anything you can do really to position your portfolio?
If you're worried about the U.S. fiscal situation, so that means you're worried about U.S. Treasuries defaulting, you're worried about the U.S. reserve currency status, things of that nature. There is only one way to avoid that completely, and that's to buy gold with 100% of your portfolio, and then probably move to a different country. Because if Treasury starts defaulting and we lose reserve currency status quickly, it means there's a major crisis happening. So I don't anticipate that. It's hard. The U.S. is dominant in the global capital markets. So even if you try to avoid exposure to the U.S. by buying other assets outside the U.S., non-dollar denominated assets, there will be some spillover into those assets. But I guess what you're really asking is, are U.S. dollar denominated assets safe? And right now they are the safest assets, and they will remain so for the foreseeable future. There is no reason to believe, regardless of some nonsensical, emotionally charged headlines that would suggest that there's some credible competitor or substitute for the US dollar. There isn't one. We'll most likely muddle through, sort it out, reduce our debt levels. There'll be another wave of austerity at some point. We'll get the budget situation at least as under control as we can, and maintain and continue to stretch out our run we've dominated the world's reserve currency status since World War II, since Bretton Woods in 47. So we're going to continue to do so. It seems hard to imagine not. So no, I wouldn't worry about that too much. You can, but the implications for how you would position a portfolio are pretty egregious.
Another question about cash. I think I know the answer, but I guess how much cash would you set aside in a portfolio to buy, in the future stocks and, other investments? So how much cash do you want to keep?
Zero. Cash is not a good, short-term bonds, maybe a little bit, but trying to time the market is a fool's errand. It's impossible to do it. So basically what you'll end up doing is sitting on the sidelines, the market goes up another 5 or 10%, then it drops 7%, and you get in and you're happy, even though it's 3% higher than where you thought it was going to, when you could have gotten in. You can't time the market. Don't try. Moving into cash, nudging the portfolio around. Like if you're a 70-30 investor, maybe go to 75% stocks if they're really cheap, or go to 65% if you think they're really expensive. But so I guess that argues for, shifting 5% around your strategic allocation. But I would have zero in stock. I would have zero in cash, and I would move it into some kind of a bond portfolio. There's always something that's cheap, or at least trading fair when something else is trading rich. So just shift it around in modest increments. Taking big swings and timing the market, it will end in tears. It always does.
A question about emerging markets and China in particular. I guess you depict a pretty gloom picture about China, and China is a big component of the emerging market, ETFs or exposure, if you want any. So how should we think about getting exposure to emerging markets and China in particular?
Things are evolving pretty quickly now in China, I think. So no conclusions yet, but there's always something in emerging markets. Having managed a pretty significant book of emerging market assets in a prior life, there's always something. Emerging markets, every emerging market investment you're ever going to have has more hair on it than every other investment, because there's an additional layer of typically political risk, because the institutions, the central banks, the treasury, the economic development institutions, they're all immature, less mature, not immature, but less mature than developed markets. So you have an added layer of risk. There's always something. The only question is, are you getting compensated for it? And for the most part, you're getting compensated to own some measure of emerging market exposure. India is an emerging market. We just got another question about India popped up. India is raging from a economic perspective. It's very solid. It's a democracy, which is helpful. They're not very open. India needs to open their borders a little more to foreign direct investment, a little more transparency in terms of their national champion companies, Adani, Reliance, others that are pretty big companies that they're kind of opaque. So India's got a ways to go. It's still, for sure, it's emerging, but it is the largest population in the world is now in India as of last March. They've surpassed China, and they're growing very rapidly, and they have democratic institutions that are likely to persist in the long run versus totalitarian, which may have, typically runs into a problem eventually. What other questions do we have? We're going to be bumping up against it pretty quick. Good thing we budgeted 90 minutes again.
I guess one question about, and there's different ways you can pay down the debt, but has the US ever thought about selling some assets to pay down the debt? They
don't have to. The assets the US owns are different than the state-owned enterprises in China. The US doesn't own companies that can have a liquid tradable market, like the Central Bank of China, which owns, or there's a layer under the PBOC that owns the SOEs, or the state-owned enterprises. And they have call it a 85% position in Bank of China. Might be 70 now because they've been selling it down. You could sell 70% of the Bank of China and raise, I don't know, $1 trillion. I don't know how much the number would be, but the US's assets, by the way, are in natural resources, our parks, our highly productive workforce, the highest productivity around, our incredible human capital, a lot of things that are investments in future income generation as opposed to the hard assets that China has. But as it stands right now, the US doesn't need to sell any assets to manage its debt. It's just going to inflate it away like every other developed country does, while we're also trying to balance the budget and do other things. It's a combination, it's a cocktail that will allow us to sort out our fiscal situation and our budget, our debt situation, and it's going to work. It always does. So there's no reason to believe it wouldn't this time. And asset sales are not contemplated. Our assets are too hard to sell. We're not in the business of supporting the private economy like other countries are. And that's where their assets come from. So when will, Neil's asking, when will China take itself off the emerging list? They're the second largest economy, but on a per capita GDP basis, they're still well below some of the definitions of that the World Bank and others and the investment banking community uses to define emerging markets. Once they have more open capital markets, so there's not the capital controls and the inability to shift capital, they need a deeper government bond market too. And there's other things that probably need to happen before they move off the emerging list, but they're moving there. They'll either get there or they won't. I mean, sometimes you run into a bit of a wall, the middle income wall, and you don't go past you never overcome the barrier, the low GDP to capita barrier that is the definition of emerging markets. Maybe one or two more.
Yeah, just wanted one more question. I mean, we talk about equities, fixed income, but we haven't said anything about alternative investments, and they're a big part of a client's portfolio, or they should be. So can you maybe remind us, why we need them?
Let's wrap it up there, because I think that's a good. There's two things to know about investing. One, and this chart tells it all. The bull markets going back to 1925 lasted a long time, and the volume that you see in some of these big green buckets represents the value creation. It's the total return from, for example, May of 46 to December 61. The stock market multiplied 9 times, 936% return. So you see these bull markets are huge in green, and the bear markets are small in orange. So stay invested. That's key. What should you be invested in? A diversified portfolio of equities, bonds, and alternatives. Why are alternatives attractive? And they're always attractive. At least they will remain attractive as long as you are exploiting market inefficiencies. That is, you're getting risk premiums in alternatives. We don't talk about them a lot because they should be a strategic allocation. So we don't tilt them around very much. We might add to real assets or subtract real assets. We just subtracted a real asset bet because we think inflation is rolling over. But other than that, alternatives should be an integral, foundational part of any private client's portfolio, because it's an integral, foundational aspect of most institutional clients. And we want to make sure our clients are getting the very best ideas and the very best investment management that they can. And the institutions, foundations and endowments, for which we run, billions and billions of dollars for foundations and endowments at Beacon Point, that's the model. That's how you win in investing, is you invest like a foundation. And alternatives are a significant part of that. That and the risk controls we provide, and having a professional investment team, including my colleague Julian, and the heads of all of our research groups, Stephen Marshall, Derek Newcomer, Jason Oberholzer, Gabe Ken, and others that are integral to our ability to deliver on the investment promise of a foundation. So yeah, alternatives got to be there, but a diversified portfolio, a diversified portfolio that includes alternatives and being run using risk controls and a strong investor foundation and mandate, that's the way to win in investing. And with that, Julian, I think we should probably wrap it up.
Thank you, Michael, and everyone for your time. Please look out for our invite in your email inboxes for our next quarterly macro and market update. That will be around the beginning of November. And until then, be safe and see you all next time. À bientôt.
Bye-bye now.